This LOS is Describe General Principles of Expense Recognition, Specific Expense Recognition Applications, and Implications of Expense Recognition Choices for Financial Analysis. Expense recognition. Under the International Accounting Standards Board framework, expenses are decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in decreases in equity other than those relating to distributions to equity participants. Remember, distributions to equity participants are dividends. General principles. A general principle of expense recognition is the matching principle. Strictly speaking, IFRS do not refer to a matching principle, but rather to a matching concept or to a process resulting in matching of costs with revenues. Matching requires that a company recognizes costs of goods sold in the same period as revenues from the sale of the goods. Period costs, expenditures that less directly match revenues, are reflected in the period when a company makes the expenditure or incurs the liability to pay. Administrative expenses are an example of period costs. Other expenditures that also less directly match revenues relate more directly to future expected benefits. In this case, the expenditures are allocated systematically with the passage of time. An example is the depreciation expense. Okay, expense recognition, general principles. This is just going to quickly look at different methods for recognizing expenses with regards to inventory. Don't worry, there's an entire reading on inventory, so this is going to be covered in more detail. But just very quickly, if the expense recognition method is FIFO, first in, first out, it means the costs of the earliest items purchased flow to the cost of goods sold. So in a period when prices are rising, the cost of goods sold is going to be the lowest because it's first in, first out, prices are rising. So our cost of goods sold is the item that was first in, it was at a lower price. So therefore, our ending inventory is going to be the highest because the ending inventory has got the most recent items that we've purchased. If the inventory expense recognition method is LIFO, last in, first out, it's the cost of the most recent items purchased flow to the cost of goods sold. Last in, first out, prices are rising, so our cost of goods sold will have the highest price. Therefore, our inventory will be the lowest because those are our older items, the prices are rising. So what do we have left in inventory in terms of our accounting? It's the older items and the price was lower. The weighted average cost averages the total costs over the total units available. So when prices are rising, the calculation is going to give us a cost of goods sold in the middle and similarly ending inventory in the middle. Again, this is just a brief general principles slide. There's going to be an entire reading and many LOS with regards to inventories. Issues in expense recognition. Moving now to doubtful accounts. Under the matching principle, at the time revenue is recognized on a sale, a company is required to record an estimate of how much of the revenue will ultimately be uncollectible. That's if the sales are on credit. Companies make such estimates based on previous experience with uncollectible amounts. Such estimates may be expressed as a portion of the overall amount of sales, like 2% of sales, or the overall amount of receivables, like 5% of accounts receivable, or the amount of receivables overdue by a specific amount of time, 10% of receivables over 90 days, for example. The company records its estimate of uncollectible amounts as an expense on the income statement, not as a direct reduction of revenues. And I've put there, we record that as a bad debt expense at the time of the sales. Moving on to warranties, under the matching principle, a company is required to estimate the amount of future expenses resulting from its warranties, to recognize an estimated warranty expense in the period of the sale, and to update the expense as indicated by experience over the life of the warranty. Issues in expense recognition. Now moving on to depreciation and amortization. Again, this is just a quick introduction to some general principles. There, in the CFA Level 1, there's an entire reading on long-lived assets, and it gets more deeply into describing the different depreciation methods and describe how the choices and assumptions affect the financial statements and you have to do the calculations. This is just an introduction to the principles. So long-lived assets are assets expected to provide economic benefits over a future period of time greater than 1 year. Examples are land, property, plant and equipment, and intangible assets, assets that lack any physical substance, such as trademarks. The cost of most long-lived assets are allocated over the period of time during which they provide economic benefits. The two main types of long-lived assets whose costs are not allocated over time are land and those intangible assets with indefinite useful lives. Examples of intangible long-lived assets with a finite life include acquiring a mailing list, an acquired patent with a set expiration date, and an acquired copyright with a set legal life. Depreciation is the term commonly applied to this process for physical long-lived assets such as plant and equipment. Land is not depreciated. Amortization is the term commonly applied to this process for intangible long-lived assets with a finite useful life. The term amortization is also commonly applied to the systematic allocation of a premium or discount relative to the face value of a fixed income security over the life of the security. And again, we'll see more of that in the fixed income section later on with regards to amortization of discounts and premiums. Continuing with depreciation and amortization, the straight line method allocates evenly the cost of long-lived assets less estimated residual or salvage value over the estimated useful life of an asset. So the depreciation expense is the cost of the asset minus the residual or salvage value divided by the estimated useful life. Now, there's other methods such as declining balance and units of production, which again, we will see later on in further LOSs under the reading for long-lived assets. But very quickly, the declining balance, step one is you have to get a rate, which is 1 divided by the useful life of the asset, times the multiplier, which is 2 for the double declining balance. So if the estimated useful life was 10 years, it would be 1 divided by 10, which is 10%, times 2. So our rate would be 20%. Step 2, the annual depreciation expense would be the rate times the net book value at the beginning of the year. And note, you do not depreciate past the salvage value. Again, we're going to see more of this later on, but this is a quick introduction to the principles in issues in expense recognition, looking at some depreciation and amortization. And the last slide for this LOS, expense recognition, implications for financial analysis. A company's estimates for doubtful accounts and/or for warranty expense can affect its reported net income. Similarly, a company's choices of depreciation or amortization method, estimates of assets' useful lives, and estimates of assets' residual or salvage values can affect reported net income. These are only a few of the choices and estimates that affect a company's reported net income. When possible, the monetary effect of differences in expense recognition policies and estimates can facilitate more meaningful comparisons with a single company's historical performance or across a number of companies. An analyst can use the monetary effect to adjust the reported expenses so that they are on a comparable basis. Even when the monetary effects of differences in policies and estimates cannot be calculated, it is generally possible to characterize the relative conservatism of the policies and estimates, and therefore to qualitatively assess how such differences might affect reported expenses and thus the financial ratios. And that's the last slide for this LOS. Thank you.